Stop looking at the charts. Look at what the banks are building on top of the charts. In 2026, we are not just trading crypto anymore, we are tokenizing the entire stock market. JP Morgan, BlackRock, and Visa have all signaled one thing, which is that Ethereum is their settlement layer. Today, I am breaking down the real-world assets supercycle and how it could push Ethereum to levels you cannot imagine this year. Most people are staring at the price of Ethereum right now in January 2026 and feeling bored or frustrated because they see Bitcoin hitting new highs, or they see Solana meme coins going parabolic, and they wonder if Ethereum is dead. But I'm here to tell you that this boredom is by design. This is the exact same feeling investors had in 2019, right before the decentralized finance summer, and it is the same feeling they had in late 2023, right before the ETF approvals. The smart money is banking on your boredom. While you are looking for the next 100x meme coin, BlackRock and the largest financial institutions in the world are quietly seizing control of the Ethereum network, not by buying tokens on Coinbase, but by building the actual infrastructure of the future global economy directly on top of the Ethereum blockchain. This is what we call the Wall Street takeover, and it is the single most important narrative for your portfolio in 2026. To understand why this year is different, we have to look at the macro picture of what happened in late 2025. We saw the launch of corporate Ethereum treasuries, and we saw the first major wave of institutional-grade tokenized products. But the price did not skyrocket immediately because these things take time to integrate. Now in 2026, we are entering the deployment phase. This is the year that the pilot programs end and the production systems go live. You need to understand that for a bank like JP Morgan or an asset manager like BlackRock, moving $1 trillion of assets onto a blockchain is not something they do overnight. They spend years testing and securing and lobbying for regulations. That work is now done. The regulatory clarity we received in late 2025 was the green light they were waiting for. Now the floodgates are about to open, and the asset they have chosen for settlement is not Bitcoin, and it is not Solana. It is Ethereum. Let us talk about the concept of the real-world asset supercycle. This is a term you're going to hear every single day for the next 12 months. It refers to the process of taking traditional financial assets like United States Treasury bonds or real estate deeds, or even shares of stocks like Apple and Tesla, and turning them into digital tokens on a blockchain. Why would they do this? It is not because it is cool technology. It is because it saves them billions of dollars. Right now, if you want to sell a stock or a bond, it takes 2 days for the trade to settle. That is 2 days where your money is stuck in limbo. In the financial world, time is money. By moving these assets onto Ethereum, they can settle trades instantly, 24 hours a day, 7 days a week. This unlocks trillions of dollars of capital efficiency. BlackRock has been very clear about their strategy. Their CEO, Larry Fink, has said explicitly that the next step after ETFs is the tokenization of every financial asset. And if you look at their actions, not just their words, you will see that they are betting the house on Ethereum. Their BUIDL fund, which is a tokenized treasury fund, runs on Ethereum. It has already grown to over $1 billion in assets. That is just the tip of the iceberg. The BUIDL fund is essentially a proof of concept. It is BlackRock proving to themselves and to the regulators that they can run $1 billion fund on a public blockchain without getting hacked and without breaking the law. Now that they have proven it works, they are going to start migrating their massive index funds and their money market funds onto the chain. We are talking about funds with hundreds of billions of dollars in assets. Even if just 1% of BlackRock S assets move on-chain, that is enough to cause a supply shock for Ethereum that will make the 2021 bull run look like a warm-up. But why Ethereum? This is the question that the critics always ask. They say Ethereum is too slow or the gas fees are too high. They ask why Wall Street would not use a faster chain like Solana or a cheaper chain like a layer 2. The answer comes down to one word, which is security. When you're moving $1 trillion of value, you do not care if the transaction costs $1 or a penny. You care that the transaction is absolutely final and that the network will never go down. Ethereum has never gone down. It has a track record of 100% uptime for years. It has the most decentralized validator set in the world. For a bank, risk management is the only thing that matters. They cannot risk a network restart. They cannot risk centralization. They need a settlement layer that is basically a digital fortress that is Ethereum. Furthermore, the fee argument is dead in 2026. With the upgrades we have seen, and the ones coming this year, which I will discuss in a moment, the scalability of Ethereum is no longer a bottleneck for these institutions. They are not transacting on the main layer anyway. They are building their own private subnets or using layer 2 solutions that settle back to Ethereum. This means they get the speed of a fast chain with the security of the Ethereum mainnet. It is the best of both worlds, and it is why 65% of all tokenized real-world assets are currently living on the Ethereum network. The competition is not even close. Now, I want to talk about the specific catalysts for 2026 that are going to accelerate this trend. The first is the Glamsterdam upgrade coming in the first half of this year. You might have heard technical jargon about this upgrade, but let me simplify it for you. Glamsterdam is all about making the network more efficient for the people who build the blocks. It separates the role of the person proposing the block from the person building the block. This sounds boring, but for Wall Street, it is crucial. It allows for more complex transactions to be bundled together efficiently. It basically greases the wheels of the machine so that institutional high-frequency trading can happen without clogging up the network. This upgrade is a direct response to the needs of the financial giants who are entering the space. They need predictable execution, and Glamsterdam delivers that. Later in the year, we have the Hegota upgrade. This is the one that changes everything for the long term. Hegota introduces something called Verkle trees. Again, ignore the complex name and focus on what it does. It makes the data required to run a node much smaller. This is what we call statelessness. Why does this matter for the price of ETH? It matters because it secures the network against centralization, even as it scales to petabytes of data. It ensures that Ethereum remains a credible neutral platform that no single government or corporation can control. This neutrality is exactly why global finance trusts it. If Ethereum were centralized by a few nodes, it would just be a worse version of a bank database. The fact that it is decentralized is its value proposition, and Hegota guarantees that decentralization for the next decade. Let us pivot to the financial argument for holding ETH in 2026. We need to talk about the yield trap. This is the secret weapon that Ethereum has over Bitcoin. Institutions love Bitcoin as a store of value. It is digital gold. But institutions also love cash flow. They have liabilities. Pension funds have to pay retirees every month. Insurance companies have to pay claims. They cannot just hold an asset that sits there and does nothing. They need assets that generate income. Ethereum is the only large cap crypto asset that is both a store of value and a yield generating asset. When you stake Ethereum, you earn a yield paid in more Ethereum. This is not like a bank interest rate that is paid in printing fiat currency. It is a yield paid in the asset itself. In 2026, we are seeing the rise of the total return Ethereum ETF. In the past, ETFs just held the asset. Now the new wave of ETFs are staking the ETH they hold and passing that yield on to the investors. Imagine you are a pension fund manager. You can buy a bond that pays you 4% but is denominated in a currency that is inflating at 3%, or you can buy Ethereum, which might appreciate by 50% and also pays you a 4% staking yield. It becomes a no-brainer. This yield is what we call the internet bond. It sets a floor for the valuation of Ethereum. As interest rates in the real world eventually come down, the yield on Ethereum becomes more and more attractive. This attracts the most conservative capital in the world. We are talking about sovereign wealth funds and endowments. These guys do not buy Dogecoin. They buy productive assets. And Ethereum is the most productive asset in the history of crypto. There's another aspect to this yield that you must understand. It is the deflationary mechanic. We all know about EIP 1559, the burn mechanism. Every time a transaction happens on Ethereum, some ETH is burned and removed from supply forever. In 2026, as the real-world asset activity picks up, the amount of ETH being burned is going to skyrocket. Think about it. Every time a stock is traded, every time a bond is issued, every time a stablecoin is sent, gas is paid, and ETH is burned. If BlackRock hits their targets for tokenization, the demand for block space is going to be consistent and massive. This creates a situation where the supply of Ethereum is shrinking every single day, while the demand from institutions is growing. Economics 101 tells you what happens next. The price has to go up to clear the market. We are looking at a supply shock that makes the Bitcoin halving look like a minor event. Bitcoin creates less supply every 4 years. Ethereum actively destroys supply every single day. I want to address the elephant in the room, which is the competition. Everyone talks about the Solana killer or the next big layer 1. And yes, those chains have their place. They are great for gaming and high-frequency consumer apps. But when it comes to the settlement of trillions of dollars of value, the game is already over. The network effects of Ethereum are too strong to break. All the liquidity is on Ethereum. All the developers are on Ethereum. All the institutional tools are built for the Ethereum virtual machine. For a bank to switch to another chain now would be like trying to get the entire world to switch from English to another language for international business. It is just not going to happen. The cost of switching is too high and the risk is too great. Wall Street is lazy. They want to use what everyone else is using. They want to use the standard, and Ethereum has become the standard. Let us look at the price targets. I'm not going to give you financial advice, but I will tell you what the models are saying. Analysts at VanEck and Standard Chartered have updated their models for 2026, and the numbers are staggering. They are projecting a base case of over $10,000 per ETH by the end of this cycle. Their bull case goes as high as $20,000. How do they get to these numbers? They use a cash flow analysis. They look at the revenue Ethereum generates from fees. They subtract the amount paid to stakers, and they apply a multiple, just like you would for a tech stock like Amazon or Google. When you view Ethereum as a tech company that sells block space, the valuation makes sense. In fact, at $3,000 or $4,000, Ethereum is trading at a massive discount compared to traditional tech companies with similar growth rates. The market is mispricing this asset because it still thinks of it as a speculative coin rather than a cash flow generating infrastructure. This mispricing is your opportunity. The window is closing. Once the pension funds fully enter the market, the volatility will dampen and the easy gains will be gone. We are in the final phase of the early adoption curve. The transition from early majority to late majority is happening right now in 2026. The headlines you see today about regulatory clarity and upgrades are the final pieces of the puzzle falling into place. You have to change your mindset. You're not buying a lottery ticket. You are buying a piece of the internet's financial layer. You are buying the oil that powers the engine of the new global economy. Every time Larry Fink talks about tokenization, he is talking about increasing the value of your Ethereum. Every time a bank issues a stablecoin, they are increasing the value of your Ethereum. You are on the same side of the trade as the most powerful financial entities on the planet. Do not let the boredom shake you out. Do not let the short-term price action distract you from the long-term reality. The Wall Street takeover is not a conspiracy theory, it is a business plan, and it is being executed in plain sight. The RWA Supercycle is the catalyst that bridges the gap between the crypto world and the real world. For 10 years, we have been playing in a sandbox with our own tokens and our own money. Now the big boys are coming in, and they are bringing their assets with them. They are bringing real estate. They are bringing government debt. They are bringing corporate equity. And they are parking it all on Ethereum. This is a multi-trillion-dollar migration. Even if Ethereum only captures a fraction of this value, the price implications are explosive. So what should you do? You should do what the smart money is doing. You should be accumulating quietly. You should be staking to earn that yield. And you should be patient. The year 2026 is set to be the year where the fundamental value of Ethereum finally reflects its price. The sleeping giant is waking up, and it is wearing a suit and tie. The infrastructure is built, the upgrades are scheduled, the institutions are onboarded. The only thing left is for the market to wake up and realize that Ethereum is significantly undervalued. Do not be the person who sold their ETH to BlackRock in early 2026 because you were bored. Be the person who understood the vision and held on for the revolution. The tokenization wave is here, and it is going to carry Ethereum to new all-time highs. This is the new standard. This is the future of finance. And you are early. I want to go deeper into the mechanics of the BUIDL fund because it is the blueprint for everything that is coming. When BlackRock launched this, they did not just create a token. They created a bridge. They worked with Securitize, a company that specializes in compliance, to ensure that every single person holding that token was whitelisted and verified. This sounds against the ethos of crypto, which is supposed to be permissionless, but this is the compromise that brings the trillions. Now, these are permissioned assets running on a permissionless infrastructure. That distinction is key. The base layer of Ethereum remains open and free for anyone to use. But the applications on top can be gated and compliant. This dual nature is what makes Ethereum so powerful. It can host a decentralized exchange like Uniswap and a regulated bank fund like BUIDL on the same network. They share the same security. They share the same validators. But they serve different users. No other chain has successfully managed to support both of these worlds at scale. In 2026, we are going to see the integration of these two worlds. We are going to see DeFi protocols accepting these institutional tokens as collateral. Imagine being able to take a loan out against your tokenized piece of Manhattan real estate instantly on Aave. That is not science fiction anymore. That is the roadmap for this year. This utility drives demand for ETH because every step of that process requires gas. It requires the network to process the data. Let us also talk about the geopolitical angle. Stablecoins are becoming a matter of national security. The United States government realizes that stablecoins denominated in dollars are a way to maintain the dominance of the US dollar globally. If people in Argentina and Nigeria and Turkey are using USDT and USDC, they are essentially using the dollar. The majority of these stablecoins run on Ethereum or its layer 2s. The US government therefore has a vested interest in the success and stability of Ethereum. It is becoming the rails for the digital dollar. This reduces the regulatory risk significantly. The government is not going to ban the network that sustains its currency dominance. This is a massive shift in the narrative from crypto is used for crime to the crypto is strategic infrastructure. As we move through 2026, watch the ETF flows closely. The first year of the ETH ETF was underwhelming compared to Bitcoin because the market did not understand the asset. Bitcoin is easy to understand. It is gold. Ethereum is harder. It is a tech platform. It is a yield bond. It is money. It is complicated. But financial advisors are now educated. They have spent the last year learning the pitch. Now they are explaining it to their clients. The inflows are starting to ramp up. And unlike Bitcoin, where miners are constantly selling to pay for electricity, Ethereum stakers are not forced sellers. The sell pressure is structurally lower. When the demand kicks in, there is very little liquid supply to meet it. This leads to violent upside moves. We are also seeing the maturity of layer 2 solutions like Base by Coinbase. Base has onboarded millions of users who do not even know they are using crypto. They are just using an app. But underneath it settles to Ethereum. Coinbase is one of the biggest holders of ETH. They are driving value back to the mother chain. The ecosystem is working exactly as intended. The layer 2s handle the speed and the users. Layer 1 handles the money and the security. This modular architecture is winning. It is robust, it is scalable, and it is live right now. The skepticism you see online is a lagging indicator. Sentiment follows price. When the price starts moving, the sentiment will shift overnight from ETH is dead to ETH is the future. Do not wait for the sentiment to shift. By then, the price will be 50% higher. Act on the data. The data shows developer activity is at an all-time high. The data shows total value locked is at an all-time high. The data shows institutional interest is at an all-time high. The only thing that is not at an all-time high yet is the price. That is a divergence that gets resolved in one direction, up. This is the year of the Wall Street takeover. It is the year where the suits and the geeks finally merge. It is the year where Ethereum cements its place as the settlement layer of the world. The stars are aligned. The technology is ready. The money is ready. Are you ready? I want to leave you with this final thought. In the history of technology, the winners are the platforms that become invisible. You do not think about TCP/IP when you use the internet. You just use it. Ethereum is becoming that invisible layer for money. It is sinking into the background of the financial system. And that is exactly where it becomes the most valuable. When you swipe your card or buy a stock or send money and you do not even know you are using Ethereum, but you are paying a tiny fee to the network that is when we have one. We are getting very close to that reality in 2026. The plumbing is being laid, the pipes are being connected, the water is about to flow. Position yourself accordingly. Look at the history of financial innovation. First comes the speculation, then comes the infrastructure, then comes the utility. We are moving from the infrastructure phase to the utility phase. The speculative phase was 2017 and 2021. The infrastructure phase was the bear market of 2022 and 2023. Now in 2026, we are seeing utility at scale. We are seeing real businesses generating real revenue on chain. This changes the valuation models completely. We are no longer valuing ETH on hopes and dreams. We are valuing it on cash flows and network activity. This provides a floor. It makes ETH an investable asset for the prudent investor, not just the gambler. The concept of the flippening, where Ethereum overtakes Bitcoin in market cap, has been laughed at for years. And while it may not happen this year, the gap is going to close. As Ethereum proves its utility as a financial instrument and not just a store of value, the premium placed on it by Wall Street will grow. Bitcoin is a rock. It sits there. It is valuable because it is scarce. Ethereum is a factory. It produces. It is valuable because it is scarce and productive. In a high interest rate environment or low interest rate environment, productivity always wins in the long run. So ignore the noise, ignore the short-term price fluctuations, focus on the trend. The trend is tokenization. The platform is Ethereum. The players are BlackRock and the global banking system. The timeline is now. 2026 is the year it all comes together. Do not miss it. Consider the role of the sovereign wealth funds. We have rumors and confirmed reports of funds in the Middle East and Asia looking to diversify away from the dollar and into digital assets. They have already bought Bitcoin. Their next logical step is Ethereum. They want technology exposure. They want to own the infrastructure of the future. When a sovereign wealth fund enters the market, they do not buy a few $1 million worth. They buy billions. They buy with a 10-year horizon. They lock that supply away. This is the kind of buying pressure that creates a floor price that is much higher than where we are today. Think about the implications of the Hegota upgrade again. It is not just about technical specs. It is about accessibility. It allows Ethereum to run on lighter hardware, which means it can be embedded into more devices. It creates a more resilient network that can survive even the most hostile attacks. This resilience is what gives the central bankers confidence. They need to know that if a catastrophic event happens, the network will survive. Hegota provides that assurance. It is the final seal of approval for the safety of the network. And let us not forget the retail investor. They will come back. They always do. But this time, they will not be coming back to buy pictures of monkeys. They will be coming back to use applications that actually do something. They will be using decentralized social media. They will be using gaming protocols. They will be using prediction markets. All of these run on Ethereum or its layer 2s. The user base is going to expand from the millions to the billions, and every single user adds value to the network. The narrative for 2026 is clear. It is the year of convergence. Traditional finance and decentralized finance are merging. And the meeting place is Ethereum. It is the town square of global capital. It is the operating system of value. If you are betting against Ethereum, you are betting against the internet. You are betting against the banks. You are betting against the future. I would not take that bet. I am betting on the takeover. I am betting on the supercycle. I am betting on Ethereum. Keep your eyes on the real metrics. Watch the stablecoin supply. Watch the number of active addresses on layer 2. Watch the amount of ETH staked. These are the heartbeat of the network. And right now, the heartbeat is stronger than ever. The price is just lagging the reality. When it catches up, it will be violent and it will be fast. You have been warned. The train is leaving the station. The Wall Street Express is departing. Make sure you have your ticket. This is not financial advice, but it is financial reality. The world is changing. Money is changing. And Ethereum is at the center of it all. Welcome to 2026. Welcome to the future. This is Asian Guy from the Asian Guy on ETH channel. Don't forget to subscribe. Class dismissed.